Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Wednesday morning, middle of a holiday shortened week. Holidays on both ends of the week, Monday and, of course, now on Friday as well. And can we hope for a calmer kind of a day? Not up, not down, just, the market doing a little bit of nothing. I mean, I hope so, because last night Wall Street did that. So lots to talk about in terms of individual stocks, lots of news flow post-market hours yesterday. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Surabhi. Guys, good morning.
Hi, good morning, folks. Prashant, I think Mr. L.A. Ryan was answering exactly the question that you asked this morning. Of course, he's a veteran with US markets and bond markets, and he said, enjoy the calm while it's here. Don't get used to it. Volatility is coming back. At least that's his view.
Well, and unlike the last couple of trading sessions where we had positive cues to start off with, today, in fact, that's not the case. And we have the futures as well that are lower because of the Nvidia results. So today, it wouldn't be such a bad outcome if we end more or less flattish in today's trading session. The last two trading sessions have been absolutely super. Last stick at the high point of the day. But Prashant, let's get straight to the action.
No, absolutely. And I think it's a little quieter.
Yeah.
The overall scene is much quieter. So let's take it from the top. I mean, it's a short one today, essentially because of that reason. Not very much really happened, not too many headlines from Trump or his team. So Wall Street takes a break from volatility, and S&P was down about 0.17%. This is not like what we've seen. The 10-year lost about 4 basis points to about 4.3%. Dollar index back at about 100. But this morning I saw it was under 100 once again. So around between 99 and 100. Basically, oil little changed, about $65 a barrel on Brent. And news flow largely still the same. Headlines suggesting that Trump, and this was the White House press secretary who said that Trump has told her that he's waiting for China to take the next steps in trade tariff negotiations. We don't know when that will happen. I mean, basically, both Xi and Trump waiting for the other guy to call. And we don't know if that phone call has been set up as yet. No confirmation. Of course, this basically suggests that de-escalation is still out of sight. It may happen suddenly. But the point is, these are the two largest economies. And even if everybody else gets a baseline tariff of 10% and, there's a trade war, big trade war between US and China, it affects everybody else, everything else as well. And I think that's the issue here. There was another sort of story, in the press, US-EU negotiations not progressing as quickly as planned. And the reportage said that US has basically rejected the offer for, zero tariffs. So you do zero, we'll do zero as well. That's not what they're looking at. They're basically looking to address the deficit per se and some of the non-tariff barriers. VAT is a big issue in EU. But of course, I mean, there are negotiations going on with us, India, Japan and others as well. And all of this will be closely watched, as I said yesterday as well, because, the first guy who gets a deal and, works something out, others will look at what the other side, which is Trump, the Trump team is ready to give, how much are they willing to bend and work with some of these other trade partners. Now, the other bit of news flow, and this has kind of gone to the background, the Ukraine, the Russia-Ukraine thing. So Bloomberg story that US and Ukraine teams will discuss the minerals deal this week. Remember that minerals deal which was being worked out. Zelensky, the Ukrainian president, was at the White House, and that became an absolute drama and a farce. So there is apparently something brewing this week, so keep an eye out on this as well. Now, I'll just put out the levels here before we kind of go any further. So we, by the way, have crossed daily averages, daily moving averages, by quite a bit of distance, by a big ferocious gap that we had yesterday, and we kind of maintained that. So the next upside level, if you want to really take a look at where the market can go, is 23,475. 23,475. What is that? That is basically the first 38% retracement of the full fall now. The fall from the high, which was on the 27th of September, to the low that we made 3 or 4 days back, which was on the 7th of April. So high to low, 38% retracement, 23,475. Support comes in at 22,888, which is the 40-hourly exponential moving average on the downside. For the Nifty Bank, upside levels are 53,159. And then, there are a few resistance levels which are converging around the 53,650 level on the Nifty Bank. And support comes in at the 20-day, 50,650. And then the 40-day exponential, which is 50,191. So that's basically, broadly, the picture. GIFT Nifty will come up on your screen, gives you a quick sense of how we start. It's about 60, 65 odd points lower. Surabhi.
Yeah, absolutely. Actually, this is not too bad because if you see the other Asian markets, now they are really falling. US futures are down quite sharply. And now other Asian markets are showing that up. Japan, for instance, is down about 0.7%. The mainland Chinese markets, despite very good data that's come out, are all sliding. The Hang Seng, for instance, look at that one, 1.8% lower. The mainland Chinese markets are down. Singapore is barely flat. So Asia is feeling the heat. Speaking of US futures, the decline on the NASDAQ now is as much as 1.5%. And we all know why. Because of this $5.5 billion charge that Nvidia declared yesterday, the shares have been down about 6-7% in after-hours trading. And this is a charge, it's a reasonable charge, $5.5 billion, for the export of their H20 GPUs, graphic processing units. It's just gotten the market a little nervous because this is where those trade restrictions get real. I mean, it costs companies real money. These barriers are real. And that's why you're seeing that downward drift on NASDAQ futures down about 1.5%. On China, the data is just out. And actually, it's blowout numbers across the board. Very, very strong. Q1 GDP is at 5.4%. Retail sales at 5.9%. March industrial output at 7.7%. These are phenomenal numbers. But the market obviously isn't cheering them because they're backward looking. I mean, April onwards, we're in a new reality. But for what it's worth, the data out of China for March was very good, in line with the talk of a recovery in the economy. Now, by the way, look at some of the downgrades that have come in. UBS has come out with a big downgrade on Chinese growth. They're estimating that for this year, 2025, growth will be just 3.4%. And for next year, 26, the growth number is going to slide further to 3%. And this contrasts with China's own estimates of about 5% growth. So let's see how this plays along, which is why the market is not reacting to very good, data out this morning. For us, yesterday was a great day, a 500-plus point rally, and it continued to sort of end on the high note. The VIX was down big time yesterday in the Indian trading action. The VIX fell 19 to 20%. It's come down to that level of around 16. So that was good news for the bulls. And all this recovery, this buying, it was largely supported by huge FPI flows. A big push came in from the FPIs yesterday. Look at that buying number. It was northwards of 6,000 crores. Major, major buying. Domestic institutions were on the other side, negative side yesterday. They sold off stocks worth almost 1,950 crores. There's a good macro cheer, by the way, for us here as well. We're talking about China macros. For us, the retail numbers are so good. Retail inflation numbers. Retail inflation in India is now down to its lowest level in almost the last 6 years. That's the lowest print, 3.6% of the print that we've got. 3.34, beg your pardon, for March. That's the lowest since August of 2019. Of course, it's lower than estimates, lower than the previous month as well. And food inflation and vegetable inflation it's come down dramatically. In fact, there's serious disinflation in vegetable prices, negative 7%. So, that run to the grocery market is not feeling as bad anymore. Core CPI inflation is still very sticky. In fact, it's inched up month on month to 4.1%. But overall, this is very good news, couples in with the predictions of a solid monsoon this year as well. So this should give us some respite and some hope. I'll quickly end with some specific stocks which could be in focus today. Definitely Mahanagar Gas, because they told the exchanges yesterday that their share of the APM gas, that allocation is coming down by 18%, and this will have an adverse impact on the company's profitability. So they're saying it as they're seeing it. So MGL in focus. And IndusInd Bank, finally that external auditor report, it's all done with the derivative discrepancies. And the numbers are very similar to what the bank had put out in its estimate. So that's good news. I mean, there's no major variance between what the external report has said, which is about 2,000 crores, which is 2.27% of net worth. So at least it puts a final sort of clarity in place on the events that happened a couple of months back. Nigel, over to you. What are you watching?
Well, the Indian markets, we have been outperforming. Post Trump's tariff announcement, the Indian markets have outperformed, and you'll want to see more of the same even in today's trading session. Because post yesterday's big run, the Indian markets are more or less flattish. You compare us with the Dow Jones or even the Shanghai Index, both of them are trading with cuts of around 2 to around 4% or thereabouts. You all mentioned about the FI net buying, and I think, HDFC Bank was the one that could have gobbled up a lot of those flows, because in yesterday's trading session, the delivery data on HDFC Bank, which is very, very close to its 52-week high at around 1,880. Well, the delivery volumes were double of what we have seen in comparison to the 10-day average. So great amount of delivery-based buying being seen on HDFC Bank, and that could be the one that will have to drive the markets higher from here on as well. But looking at the futures data, well, there was a bit of a short covering bounce, and bang on. On the Nifty itself, there was a short covering bounce that did play out. On the Nifty Bank, it appeared that there was some long addition out there. And that perfectly tallies in with what the FIs did in yesterday's trading session. Because we're making this point that they were adding shorts. They were adding shorts. They added close to around, the short positions went up from around 30,000 contracts. It went to around 1.15 lakh contracts. And they got that right because the market saw a cut of close to around 1,200 points. But take a look at what happened in the next two trading sessions. In the last two trading sessions, the FI net short positions have come down by close to around 25%. Let's get that graphic up for you on the screen yet again. The FI net short positions are down by close to around 25%. And you have the markets that have seen a rally of close to around 1,000 points. So that's the power of short covering, and that's exactly the way it's played out. Keep in mind that the FI net short positions are still at around 85,000 contracts on the short side. But the FIs, they covered shorts both on index futures, even on stock futures. There was a bounce, short covering bounce that played out. The FI net buy number on stock futures was huge yesterday. And that perfectly tallies in because on the stock futures, there was 45,000 contracts that they added on the long side. Moving to the options data, the called writing seems to have moved up. Some of those lower level called writers, well, they got stumped out yesterday. But now the action has shifted to around the 23,300 to 23,400 calls in yesterday's trade, which brings us to the levels. The near-term resistance on the Nifty will be at around this 23,500, going by the options data. You'll see a further breakout once we get past the recent high, which is at around the 23,900 odd mark. But the 20 DMA, that becomes the level you don't want to break on the downside. But the Nifty Bank will have to lead the way. It's been showing strength for the last couple of trading sessions, and even from here on, it'll have to do well because it's only around 4% away from the 52-week high, while the Nifty is close to around 11% away. So that's telling you that that one's got the momentum. Finally, the stock that I'm looking at is Havells. Yesterday, there was some news flow with regard to them buying a minority stake in a solar company. Some sell-side analysts didn't like it. The stock initially did see a bit of a dip, but it's now trading above the 20 DMA. And from yesterday's lows, in fact, it did see a recovery and ended at the high point of the day. And there was delivery-based buying on Havells as well. So I'll keep an eye out on this stock.
Okay, all right. Got that. Nigel, thanks for that. Let's get started then with the equity call of the morning. Jonathan Garner of Morgan Stanley says that their top-down earnings forecasts are cut to well below consensus, mainly on meaningfully lower house economic growth numbers. He stays defensive, waiting for an improvement in their true signposts. Among the larger markets, he says they're keeping their core recommendation of overweight domestic India, domestic Japan, Singapore and UAE, equal weight on China and underweight on Taiwan as well as South Korea. Jonathan says on the sector side, they're underweight on global cyclicals and in particular remain cautious on semiconductors, IT as well as autos.
Okay, well, let's get in. William Lee, Chief Economist and Executive Director at the Milken Institute. He's with us now. Lee, good morning. Great to have you with us here. Appreciate it. Good morning, Prashant here. So there are the two big blocks. Talks are continuing, trade negotiations, etc. But the two big blocks which matter for global markets is China and EU. With EU, the big headline overnight was, and I'm quoting this, EU says, expect US tariff talks to make little progress. And of course, with China, apparently both leaders are waiting for the other person to call. So how is this? Is this going to be, in your opinion, how is this going to proceed? Is it going to be protracted? What's your sense?
I would have been stunned if anybody expected that offer of, zero tariffs for zero tariffs to be treated seriously. Ever since the I think WTO has focused in on tariffs and tried to eliminate those tariffs as trade restrictions, the way that most countries have been trying to protect their domestic sectors has been through non-tariff barriers, whether it's explicit quotas or incredible regulatory restrictions and at high standards, whether it's health or safety or some other such thing, legal hurdles that American companies are asked to go through. And the Europeans are masters at doing those sorts of non-tariff barriers. And so that really is the heart of the discussion that has to start. So I think President Trump regarded that zero tariff for zero tariff offer as not even an opening salvo. it was a joke. So I don't think that was to be taken seriously. And I think once the Europeans get serious about wanting to open up their markets for U.S. products, then the serious discussions will continue. As you say, the big elephant in the room is China. China has been the focal point of President Trump ever since his first administration. And China is really in a situation where it recognizes that U.S. and China, the two largest economies in the world, the global trade system, as WTO is today, was formed after World War II, set up by the United States to try to help the development and recovery of economies around the world. The U.S. was the only healthy economy at the time. Now we have incredibly strong and powerful emerging countries, India, Brazil, a lot of countries coming out of not just developing stages, but into the middle class. And these middle class emerging countries require things that WTO is not able to do. So I think the key for China and the U.S. is to set a pattern, to really take apart the WTO system as it exists today, arrive at a mutually beneficial trading system for the 21st century, the needs of the 21st century, where you have huge blocks of European, Asian, Middle Eastern and Latin American countries that really have very different needs. Probably will have more bilateral agreements, much more in the way of regional agreements. And that's, I think, going to be the trend going forward. But China has to move with the U.S. Right now, we have a big face-off. There's just no way that President Xi is going to look to anyone like he's being pushed around by an American president. His domestic audience will not allow that. So I think we're going to have quite a bit of, face-saving, belligerence and a lot of tough talk until we start to see movement. And that may take a while.
Yeah, okay, so it will take a while. William, hi, morning. Great to have you on the show today. So the thing is that usually markets ignore a lot of, real economy talk, trade talk and tariff talk until it starts getting real in terms of corporate profits, corporate expansion plans. And look at the example today. Nvidia's, stock is sliding lower. It's taken, U.S. futures down with it. Generally, there's a risk-off sense in the market again because it's getting real. When you have to spend $5.5 billion in a charge because you can't export a certain number of chips to China or to other countries, it's a straight business hit. From a market perspective, should we believe that the worst of the market volatility, this 7-8% swings in a day, is that over? Can we hope for some calm, or would that be, a little maybe foolish?
That's a brilliant question, because that really is the point of this show, isn't it? Your audience doesn't care about what people like me have to say. They really care about what it is that you were just talking about earlier. Where can you make short-term trades and medium-term trades in order to benefit from the economic environment? And as you say, the volatility has been incredibly high, I think, because the discussion has been misplaced. Everyone is focused on the uncertainty due to tariffs. Oh my God, what are tariffs going to be doing? For me, it's really the big uncertainty is whether or not President Trump is going to be able to achieve the kind of economic restructuring for the United States and, as I just mentioned, for the global trading system. The Make America Great agenda involves quite a bit of restructuring. And the key policies that will be put in place would be smaller government to release resources for the private sector, lower taxes, fewer regulations, and a tariff barrier, a protective barrier for investors who come into the United States and set up shop. They'll be protected from unfair competition from abroad. Those are the key elements, and the tariffs are but a minor player in those elements. And President Trump is right now dissipating so much political capital. I think the big worry and the source of this volatility are nagging sense of he may not get this agenda through before the midterm elections. And if he doesn't, then game over. So I think that is where the real worry should be, and that has not been talked about enough.
All right, William, good to hear your thoughts as always. This is Nigel on this side. Before we wind down this conversation, I recall a couple of months back when we had a chat, US was the only game in town and the dollar index was getting stronger as well. Things have changed since then. The hope is that there'll be some outflows from the US equities and it could find its way into emerging markets like India. Do you agree?
I think one of the things that would feed that would be diversification. But right now, everyone's afraid about to diversify because the standard tricks for diversification, go to fixed income assets, go to treasuries, safe havens, those don't work anymore. But as I think to follow up what I just said earlier, I think your audience would be interested to know that the dollar weakness and the kerfuffle in the treasury market is not so much due to the loss of the status of the U.S. dollar and in lack of confidence in the U.S. Exceptionalism, but rather something simple. A lot of leveraged traders out there bought a lot of equities on margin, and now with the crash of stock prices, there are huge margin calls. So what do you do when you have a margin call? You sell the most liquid assets you have on hand, namely U.S. Treasuries and dollar-denominated assets and dollars themselves. So I think that really has been the source of this huge amount of volatility in the bond market, dollar market, which has frozen up any movement anybody has to diversify their portfolios to international equities. So right now, the proof of the pudding of what I just said is that you see that the U.S. Treasury market has come back to more normal status. The dollar, is moving around a bit, but it's still higher than it's been in the last 4 years. So I think one of the things that you should continue to look for would be more signs of deleveraging and more signs of imbalances within institutional portfolios and a lot of the hedge funds out there.
All right. By the way, there's a great background, Lee, behind you. I mean, is that a map or is that there's a painting?
That's a painting.
It's a painting.
That's a painting. It's something my uncle. Those are peach blossoms.
Oh, lovely, lovely. Great background and good to sort of, see this in the morning. Thanks very much, William, and we'll speak again soon.
Thank you so much for having me.
Appreciate your time here. Thank you. Well, I think while the global story continues to pan out, there is, disinflation here. Which is very much the case. Lata is here with the latest CPI numbers which came out and why we should pay attention to it. Lata, over to you.
Oh, absolutely. We have to pay attention to this inflation number. 3.34 is a 5.5-year low, and 3.34 is way below what the street was expecting as well. Our own poll was 3.59. I'll give you another level of surprise. If you take Jan, Feb, March, 4.26, 3.6 and 3.34, the average is 3.7. You know what the Reserve Bank had forecast back in February when they were giving you the quarterly forecast? 4.4. So look at the level to which inflation has surprised on the downside for 3 months in a row, even the Reserve Bank. Now, why was the number so low? Primarily because the big bugbear, food inflation, fell to a low of 2.69%, something like a 3.5 or a 4-year low as far as food prices are concerned. And we must know that we are coming from 18 months of 6 to 11% food inflation, ending January 2025. It's only then that it has started falling. The fall is across the board. Vegetables, minus 7% year on year. Of course, last year was really high. So these look really good. Eggs have fallen both month on month and year on year, about 3% year on year. Pulses, again, down year on year, that and month on month. So all these are, heavy protein items. So it's very important, the kind of things that are falling. Edible oils and fruit were the only ones that are still resisting. The core CPI we should come to, which is the non-food, non-fuel, that's gone up a bit to 4.1, but no worries here. If you deduct gold, gold is included as personal services and therefore works its way into core. If you deduct gold, it is 3.2. The point I'm trying to make is, across the board, the inflation number is way below the MPC's mandate of 4%. In fact, Goldman Sachs has said that even their April number is 3.1. Now, why am I bringing that number? Because when the RBI and the MPC go into their meeting on June 6th, the last number they will have is April. May numbers will come only by the 14th of June. The last number they have is April, which will be 3.1. April, Jan, Feb, March, April, the average is something like 3.5, if it indeed comes at 3.1, the April number. Now, you have a mandate of 4, and the last 4 months are an average of 3.5. Who is to say the MPC will not say, actually cut by 50 basis? Let me tell you, all the economists I asked said, no, that would be panic. But, the governor can still communicate and say, I'm advancing the August cut to June. My point is that we are in a serious disinflationary situation. China is not going to be able to export as much to the United States. Those goods will be sloshing around in Asia somewhere. They will have a disinflationary impact on Asia as well. So we have to be prepared for pretty disinflationary times. And we don't have a very good growth number. IIP number came in at 2.9. So, every reason for the MPC to argue that growth needs a much bigger helping hand. In any case, the consensus has clearly moved now to 5 rate cuts in this cycle. We began with 2 or 3. 5 would mean you take the repo rate down all the way to 5.25. So seriously, we are expecting big rate cuts.
for once, at least for now, I'm not complaining. It was almost unbelievable to see that disinflation in vegetables and, in the food product prices, which have been pinching so hard for many, many months. In fact, almost feels like years. Lata, thank you so much for that. So good news on inflation.
You've gone, as they say, bhaji shopping recently?
Even if you don't physically go in, the apps keep you updated, And when the apps, your weekly bill goes down, it's a great feeling. Why not?
I used to try to, because you really get a sense of where prices are.
The real world, yeah.
But
it's feeling much better. I can tell you that.
Are not cheap. That's what you want in summer. What you want most is not very cheap.
We'll take what we've got. And I think, minus 7% on vegetable inflation, it's a great number to have. Lata, thank you so much for joining in with the analysis today. Well, let's tell you what's lined up on the show ahead. Lots of interactions and conversations coming up. At 8:35, Adrian Moat joins in. He's, of course, a veteran of emerging markets, has been watching India as well for many, many years and decades. He talks about the tariff impact on Asia as well as global markets. At 9:20, Manish Chokhani of MR Capital Partners joins in. He's the market master of the day. At 9:30, we will have with us the Steel Secretary of the country, Mr. Sandeep Poundrik, joins in. Lots to discuss, including, of course, some of the protectionist measures that the Indian steel industry has enjoyed recently and whether more is needed given the tariff uncertainties. Following that, Shantanu Chakrabarti of BNP Paribas joins in. We talk to him about the key expectations from the banking sector as far as the Q4 earnings are concerned. A little later at 9:50, Gopal Balachandran of ICICI Lombard joins in to talk about the Q4 earnings fine print. And towards the end of the show, in our special segment, it's the economy. Lata today speaks with Samir Goel of Deutsche Bank on Indian and global interest rates as well as currencies.
Well, time to slip into a quick break. Got a lot of stock-specific action lined up for you in our top 10 segment on the other side. For the time being, I'll run you through the list. ICICI Pru Life, ICICI Lombard, IREDA, Oil India and Vedanta. They'll be reacting to positive news flow. We have 5 apiece. IndusInd Bank, IGL, MGL, Adani Total Gas and Gensol will be reacting to negative news flow. Slip into that break, come back. We'll get into further detail on all of these names.
Welcome back. You're with us on Bazaar Morning Call. And as we've been telling you, cues across global markets have turned a little challenging because of the slide that we're seeing on Wall Street futures. And most of the Asian markets are also in the red. Hong Kong down about 2% now. Japan's down about 1% or so. Let's pull up the implied open. The last time we checked, it was suggesting that we'll start probably 60 to 65 points lower. Still around that level, 53 points, actually a little better off. So let's see. Promises to be slightly more volatile than yesterday, at least at the start. Now, what about individual stocks? Well, let's straight away get to our team, which is standing by with the CNBC-TV18 list of top stocks to watch for the day. Guys, morning to all of you. Ritu, let's kick it off with IndusInd Bank. So this external committee has finally, given its sense on the derivative discrepancies. What's the latest?
Well, yes, Surabhi, good morning. IndusInd Bank has finally received that PwC report on discrepancies, and that pegs the hit at 1979 crores, which is actually slightly below street estimates, and we understand broadly in line with RBI's initial assessment as well. And the bank has now revised the impact to 2.27% of its December net worth post-tax and will reflect it in its FY25 financials. So no ugly surprises on that front, which is positive. But the concern is the delay in disclosure and accounting discrepancies that may have larger consequences, because we understand at least 3 senior level exits are likely, including the CEO and the deputy CEO who oversaw global markets, including the derivatives portfolio. Now, the RBI, we understand, has also asked the board to submit the shortlisted CEO names 4 to 6 months before Katpalia's term end next year. IndusInd Bank, however, has denied receiving any such communication or any management shakeup.
Okay, all right. Thanks a lot for that, Ritu. Well, let's hop across to Yash. He's tracking ICICI Pru as well as ICICI Lombard. Yash?
Well, Nigel, good morning. So I'm going with green as far as ICICI Prudential is concerned, and that is because there has been a very strong beat and improvement which has come on the margin front, though on one hand the growth has been a little bit slow. So new business premium, that grew at 14%, coming in at about 7,444 crore rupees. total APE was down 3%, retail APE was down 2%. This is the slow growth on the top line that I'm talking about. Value of new business grew by about 2%, and margins, as I said, a strong beat and improvement coming there. Up 120 basis points at 22.7% versus 21.5%. Street was anticipating a number of 21.8%. It's managed to beat that also with that number of 22.7%. Also, the stock is down 14% in the last 3 months. Because of these two reasons, I'm going with green on ICICI Prudential Life Insurance. ICICI Lombard, again, I'm going green, and that is because the strong, performance which has come overall in their earnings. As far as net earned premium is concerned, that grew by 20%. Underwriting loss was down 11% at 210 crore rupees. Operating profit, that was down 26%. That was largely because the investment income saw a contraction in the quarter. Nothing apart from that. Combined ratio was up just about 20 basis points at 102.5 versus 102.3. So no major damage being done on the combined ratio level also, and the protection continues there. Hence, I'm going with green as far as ICICI Lombard is concerned.
All right. Actually, we have the management coming up at 9:50. You'll hear from the Yash. Thank you for that. The management Gopal Balachandran will be with us to talk about those numbers that Yash pointed out. So, conversation a little later. IGL, MGL and Adani Total are in focus as well. Sud is here with details. Good morning.
Morning, Prashant. So first, APM gas price increase and now the APM gas allocation cut. While the APM gas price increase announced on 1st of April was as expected, but this allocation cut has come as a surprise. Government has announced that APM gas, that is administered price mechanism gas, allocation has been cut by 18%, and now total allocation would reduce to 40% from the current level of 51%. Remember, in the last 1 year, the reduction has been almost at 50%. If you remember, in 2024, in the beginning of 2024, the allocation used to be around 80%. Now it's going to be 40%. What do these companies say? Companies say that this allocation cut will have an adverse impact on profitability, and that's the reason I'm going with red for all the three companies.
Okay, all right. Got that, Sudarshan. So we'll keep all of these stocks on our radar as well. IREDA reported numbers yesterday. Let's go back to Abhishek to figure out how they were. Abhishek.
Well, IREDA reported a good set of numbers in Q4 FY25, but we need to watch out for their exposure in Gensol engineering, which will be in the minds of investors in trade today. So disbursements are up 0.5% YOY, but they are up 73.6% sequentially. The AUM growth is healthy at about 27.8% YOY and about 10.5% sequentially. So the yield has actually worked very well for them. They have got higher yields in this quarter, which has helped the NII growth at about 57.3% YOY and about 22% on a sequential basis. So provisions are up 24.5% quarter on quarter, but they have reported strong bottom line growth of about 49% YOY and about 18% sequentially. The spreads have improved. So for FY25, the spreads are at 2.42% versus 2.16% on a year-on-year basis and about 2.28% that they recorded in Q3 FY25. Their asset quality also improved. Gross NPA ratio is down to 2.45% versus 2.68% in the previous quarter. So based on numbers, the numbers look really good, but sentiments that will weigh on investors' mind is the exposure that they have to Gensol engineering. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, let's hop across to Sudarshan. He's here to tell us about Oil India and Vedanta. Sud?
So in the latest round of auction that has been done under open acreage licensing policy, Vedanta's Kane Oil and Gas has received total 7 new blocks, and Oil India has secured 9 blocks. For Kane India, new blocks comprise of 4 onshore and 3 shallow water in Saurashtra and Mumbai, and with this, Kane's portfolio increases to total 69 blocks. For Oil India, 6 blocks secured as sole operator and 3 has come in as consortium partner, and with this, Oil India's total exploration acreage increases to 1.1 lakh square kilometer, and that is an increase of almost 85% if you compare against the same level of last year. So it's going to be positive for both these companies, Vedanta and Oil India.
All right. So thank you very much for that. I mean, the other story, of course, which I guess was really dominating headlines last evening was the story of Gensol. Absolutely shocking details coming through in that SEBI order. Yash is here to quickly recap some of the findings. Yash, take it away.
Well, Prashant, the stock's already seen a damage of as much as 90% in the last 1 year. SEBI's come out with an interim order yesterday. Though it's an interim order, but the allegations which have been made and the explanation of the allegation pretty serious at this point of time. Just to summarize the allegation, misutilization and diversion of funds of Gensol in a fraudulent manner by the promoters of the company. The promoters of Gensol benefiting from these diverted funds out of the company and misleading market regulators, SEBI, the credit rating agencies, lenders and investors, all through this entire process of doing all these violations. As far as the order is concerned, what SEBI said is that Anmol Singh Jaggi and Puneet Singh Jaggi, the two promoters of the company, will be restrained from holding any position of a director or KMP in Gensol Engineering. Gensol Engineering, Anmol Singh Jaggi and Puneet Singh Jaggi will be restrained from buying, selling or trading in securities directly or indirectly. Also, market regulator will appoint a forensic audit committee which will conduct this forensic audit, and the report will be submitted within 6 months of this committee being appointed. Importantly, a stock split was also announced very recently as far as Gensol is concerned. That will be put on hold immediately.
Okay, all right, got it. So, yeah, not such great news and pretty, scathing observations and comments coming in that SEBI order. Thank you for that, Yash. Let's quickly recap our list of stocks to watch. The ones that have positive news flow around them are ICICI Pru Life Insurance, ICICI Lombard, IREDA, Oil India and Vedanta. Stocks with negative news flow around them would be IGL, MGL, Adani, Total Gas and Gensol Engineering. All right, that's the stock list. Let's go across to Manisha Gupta with the latest commodity market action. Manisha, good morning.
Morning, and thank you for that. So we will. The safe haven buying clearly continuing in case of gold, with the dollar index now trading below 100. Gold continues to see further gains here. We are trading at an all-time highs yet again, above $3,275 an ounce at this point in time. There is strong buying, whether it's by ETFs or from the central banks as well, and that clearly has been supportive. So while gold continues to do very well, the other commodities not so well in the Asian markets right now. You have the crude oil prices, which have slipped yet again to near 4-year lows. The metal prices after those initial gains also seem to be now consolidating, and some marginal losses as well. Copper, aluminum, 0.25% on a weaker side at this point in time, as the markets continue to deal with a lot of uncertainty when it comes to the tariffs there. I also want to talk about rubber, which is also trading lower. It's down 4% on a week. And the biggest of declines, when you look at industrial agriculture commodities, that clearly comes in from sugar. That one is trading at a 30-month low. Sugar prices have declined by 12% in last 1 month. So apart from gold, everything is in a bit of a profit-taking.
Okay, all right. Got that, Manisha. Thanks very much. We'll take a very quick break on that note. On the other side, we'll connect with Adrian Moat, who is an investor at Hong Kong SAR and an expert in emerging markets, to talk about the volatility and how to navigate it. Welcome back. We continue to ask that question, is the worst behind us in terms of the financial market impact of what has been, a mini storm in the first half of April? Adrian Moat, investor at Hong Kong SAR, is with us for some perspective. Adrian, always a pleasure to speak with you. And you've seen these periods several times on one pretext or the other. Now it's this whole US tariff conundrum. So we don't know how these deals are going to happen, whether China is going to blink or not. But what's your sense? I mean, is the worst of the price damage in financial markets, is that over?
Sure it is. I think we're moving into a period where we're going to see the highest level of US tariffs, arguably in history, and certainly in terms of the more modern trading history. So we're looking for an average level of US tariffs just above 20%. Now, remember that Trump did remove those very extreme reciprocal tariffs in most countries, with the exception of China, but he left in place a 10% tariff. And I think the outlook for the summer is going to be very volatile economic data. We'll have strong data as inventories were built, as companies tried to get ahead of the tariffs. And then you're going to get very weak data. People are going to be very reluctant to ship to the United States for fear that there is a deal done and tariff rates are reduced and they end up with expensive inventory. I think for the outlook for earnings looks very troubled in the United States, and I'd expect initially companies just to say they're not giving any guidance, they're removing guidance, but eventually that will move into earnings revisions going down. They're going to go down both because demand will weaken as the consumer purchasing power in the United States weakens and as margins are under pressure because of these tariffs. I think that all leads to what's going to be quite a difficult summer for US equities. And unfortunately, if US equities are having a hard time, it tends to be difficult for other equities to do well.
Hi, Adrian. Good morning and good to see you. When the US equities, but to be fair, they ran ahead, like no other global market. And they were the big outperformers. There was a rush of capital towards the US. Now, with this kind of uncertainty, what we've seen in the last couple of months or so is that India has come back because we underperformed. Valuation became a little better. And, that entire reversal of that trade, that buy China and sell India, that seems to be reversing in the last month or so. From emerging markets, do you think India is better placed at current reckoning?
So there's a couple of parts to that story. I think actually India and China are quite well placed in this dynamic that's going on here. Both countries have, an ability in China to stimulate. Indian economic growth has been relatively robust. India's exposure to traded goods to the United States is quite limited. It's obviously much greater if we look at the sale of software services, etc., to the United States. So I would agree that India has some defensive qualities. The issue that investors are having is that Indian valuations remain very high, and we're in a process of derating the US equity market. And I think that PE compression that's occurring, which is a very sensible PE compression because we're concerned that the economic outlook is very difficult to predict, so you have less confidence to pay up for high valuations. And secondly, we don't believe that discount rates are going to come down to try and compensate for that level of uncertainty. So I think at a fundamental economic level, India looks good, but it still seems to be incredibly well priced. And if you look at the dispersion in the Indian market, the likes of like a Bajaj Finance that's done incredibly well year to date, you're paying very, very high multiples for that growth and for that type of business. And I think investors are continuing to sort of be cautious about paying high prices in what's a very uncertain environment. And why China has been looking more attractive to them is that the Chinese tech names are relatively inexpensive and have actually been benefiting from positive earnings revisions. So if you think about, how does China respond to weakness in its external sector due to US tariffs? It has to stimulate domestic demand more. And so if the equity market is led by domestic demand stocks, which is what is listed in China, then they can actually do quite well. I think a lot of the damage from these trade wars is not going to be felt by listed China names. It's going to be felt by the large US multinationals, with Apple being, the poster child to how damaging these tariff wars can be.
Adrian, we'll leave it there for now. Thank you very much for joining us. Good conversation and really sharp points you make. And this is a story which we will continue to track with you over the next many weeks, depending, of course, on the pace of how this proceeds. Thank you very much for joining us. That's Adrian Movat with quick perspective on things. Well, let's just quickly take a look at the markets, of course, on the gift Nifty is doing. I think we're still down about 50 or 60 points, so not very much by way of change. Actually, a little bit of recovery, if anything. At 8 o'clock, we were down 65. Now we're down about 40. Devin Choksi is with us, managing partner at DR Choksi FinServ. Devin, good to have you with us here. Thank you for your time. Yesterday, the top gaining sectors were what? I mean, actually, all sectors were in the green. Top of the list were sectors like autos, which have been beaten down because of that sort of, possible exemption, etc. Tata Motors and so many auto-anked names which did very well. Metals, of course, interest is starting to come back. Stocks have gotten smashed. So let's just start with those two. What do you like there, Devin?
Good morning, Prashant. Well, certainly, I think the internal fundamentals of these companies, they remain absolutely convincing and strong for most of the auto companies. The domestic demand scenario remains, I think, relatively more comfortable. The exports, yes, of course, I think in a way, if the tariff-related issues come in the way, some part of the impact could come, but which I believe that it could last only for 3 to 6 months, after which it could probably get normalized. That's what our take would be. But let's not calculate that part now, because we are still 90 days away from that activity, if at all the tariff is implemented. So we remain relatively more confident about the domestic story of Indian auto companies. And particularly, we believe that electric vehicles are the ones, I think, which are shaping up the new demand scenario in the country. So companies with the portfolio of electric vehicles are expected to relatively do well. Some of the ancillary companies are expected to do well on two counts. On one side, the input cost, I think, remaining under control, thanks to the lower gold oil price, lower commodity price, and the lower impact of the currency as well. I think that is basically working well for some of the input costs for the auto ancillary companies. And that's where you like to position the companies like Minda, Minda or Minda Power, for that matter, I think, in the portfolio. We believe that I think overall environment should remain relatively positive for both metals as well as for the auto ancillary sector in general.
Okay, all right. Hi, Devin. Good morning. Good to see you in. What about banks? Phenomenal run is what we've seen out there. And the big boy, HDFC Bank, massive delivery-based buying is what we saw. They've cut their savings rate as well yesterday, and they had some room to do that. So the cost of funds will fall, and that's why, most brokerages are estimating 5 to around 7 basis points increase in their NIMs in the first quarter of FY26. Your view on this one? It didn't perform on the way up, but now, in fact, that's fine, coming back into its own. HDFC Bank.
Yes, Nigel, good morning. Well, it's catching up well. I think on one side, the liability cost, I think, is coming down, which is a good point. And at the same time, the prospects of improvement in the NII, NIM, particularly, I think, is more important. We believe that the larger banks like HDFC and SBI would be relatively in a better position, also because of the fact that the credit growth is remaining in the vicinity of around 16 to 18% in general for these banks. And that's where probably I think you are likely to see the better profit performance coming in. We do like, I think, the likes of Kotak in the portfolio, or even for that matter, ICICI, because I think they're positioning well with their different lending portfolios, be it retail or the corporate side of the activity. I think they're well balanced. So we believe that I think there is an opportunity to make money into these companies, close to around 10-15% kind of upside can't be ruled out, including some of the larger NBFCs like Bajaj Finance. I think the conviction is relatively on the higher side.
Devin, good morning. I also have a bank question for you today. IndusInd Bank, because now the numbers are finally official and the hit is just less than, just a little south of 2,000 crores. So the uncertainty in that sense is out of the way, though our colleagues are reporting that there could be some senior level management exits as the RBI continues to take stock of what happened. The stock is obviously at a very, very deep discount. It's just 20% off its 52-week low. What would you advise on IndusInd?
Yes, good morning. Well, maybe some kind of re-rating is not ruled out in this kind of a scenario, given the fact that the liability part is known already now, so that is getting discounted into the price. And that's where probably some contra buying, some amount of support buying can take place in the portfolio of funds. who have been holding on to this particular stock. Maybe I think it's a time to trade in, trade out, where you are buying at lows and probably selling it out at higher level. As I see it, I think the stock could get re-rated, but at the same time would trade in a range. And it could possibly, I think, fluctuate in that particular range for some longer period of time.
Okay, all right. Point taken there on IndusInd. I mean, big move, right? And by the way, the stock opened just 10 rupees higher. So unlike, and yesterday was a big gap up for the market. Yesterday it opened 10 rupees higher, and then, I mean, everything else came later. And the high was made at about 12 or so in the afternoon. About 7% up is what we finally closed at on IndusInd Bank yesterday. What else? Devin, I don't know. I'm not sure if you track some of these mid-cap names which saw very large moves. I'm just going to throw these names and come in if you have a view. Fino Payment was a big volume-led mover yesterday. There was Intellect Design, which went up very sharply. Mazgaon from the defense space was a sharp mover.
Yeah, Prashant, I believe that I think some of these names probably will have the tendency to go up largely because of the follow-up buying taking place into the portfolios of the investors. Not completely sure about the valuation at this point of time in these cases. But yes, I do agree on one aspect that when the market punished some of the quality mid-caps in the price fall, I think with the confidence coming back into the market, they are likely to find a buying into these counters. And that's where I think we remain selective about the quality of the companies, the fundamentals of the companies, by adding them to the portfolio in the mid-cap space. We are not typically going after the momentum at this point of time because we believe that there are too many moving parts currently floating around, which probably I think would create some part of the risk in the portfolio if we chase momentum at this point of time. So we stay with the quality fundamentals and even mid-caps that we have in the portfolios.
All right, Devin, stay with us. We're going to take a quick commercial break here. We're going to come back with some technical trading ideas. Sudarshan and Mitesh are going to help us with that in just a bit from now. Stay tuned.
Welcome back. Well, let's get a quick technical check on the markets. The last couple of trading sessions have been very, very beautiful because we have started off in the green and we're built onto those gains. How do you trade today? Because we're going to see a 40-50 point downtake. Sudarshan and Mitesh are joining us on the show. Good morning, gentlemen. Well, yesterday, both of you all had the view. You need to buy any kind of dip and play it on the upside. And that's played out for the last couple of trading sessions. What do you do today, though? We are likely to start off with a cut of around 50 points. Do you buy the dip? Mitesh, you go first.
Morning, Ajit. I would want to buy the dip. The idea is that with yesterday's gap up and the closing near the day's high, I think we will see continuation on the upside in coming few days. 23,400 was one of the target areas. We got a high of around 23,370 yesterday. And now anything closer to about 23,250, 200 zones would be a welcome buying opportunity, though the gap down is still smaller. But in case you see about 100 point kind of a cut, I would want to get into long positions on the index. Having said that, despite this gap down, I think on the stock side, we are positively biased and looking at identifying stocks where long positions or long positions can be taken with a good risk-reward equation. And that's how we are doing.
Okay. Gentlemen, morning. Sudarshan, how are you looking at the setup this morning?
Yeah, good morning. Well, it's always a better setup when I can say, let's buy on a dip. See, the market trend, the short-term trend is now up. Within this uptrend, we will see small setbacks as we are going to see in the morning today, and that's fine. That allows the trader to enter at a lower price. The trade still is look for intraday dips and go long there. Now, the dip could be at least 100 points from the open. That would be ideal. Or during the day, a sideways move, which suggests that the market is now going sideways rather than sharply down. In either case, look to buy the Nifty.
Okay, look to buy the Nifty. Sudarshan, what would your picks be?
Well, it's an all buy list. And of course, markets can do something very different. That's a separate point. Dr. Reddy is a buying opportunity with a stop under 1133. Bharat Forge is a buy, stop under 1050. Chola Finance is the preferred buy. Let's say that it's a positional buy also. Keep a stop under 1528. And Oberoi Realty, another stock which should do rather well, is a buy with a stop under 1598. These positional buys can be taken, although for the Nifty, I would suggest keeping it intraday. But stocks you can carry when you find good quality stocks.
Okay, got it. So we have got those picks up on the screen as well. Sudarshan's picks out of the way. Mitesh, what about you?
Yeah. I have all my points. Buy on Dixon Tech with a stop at 14,600 for targets of 15,500. A buy on BHL with a stop at 217 for targets of 230. Adani Solutions is also a buy. It's a conditional buy. It's closed at about 887. So the level to buy above is 890. That's the pivot. So buy above 891, 892. Keep a stop at 870. Look for targets of 945. And on a mild decline, Geo Financials is a buy for around 236. Buy with a stop at 231 for a target of 248.
Okay, Adani Energy, Geo Financial, and what was the third one, Mitesh?
So I had Adani E-Solutions, Energy Solutions, Geo Financial, Dixon, and BHL.
BHL. Okay, got it. Thanks a lot for that, gentlemen. Well, for the time being, we'll slip in a short break. We'll be back. We'll get you pre-opening rates. We'll also be joined by Sumit of Kotak Securities. He'll talk about the APM gas allocation. Stay with us.
Okay, welcome back. There's a minute to go for the pre-open session. I sat down with Manish Chokhani, director at Enam Holdings, for a conversation on the changing and shifting macros around the world. Trump tariffs, of course, are the prime mover, but there's so much else which has been happening. So we spoke about what will do well. Manish believes that hard assets will do very well and emerging markets will do well. Gold in hard assets is the go-to according to him. I also sort of asked him what the equity market here in India is likely to do. He thinks for the next few months at least, we are likely to be in a bit of a holding pattern. Listen in.
I mean, on balance, we are in good shape as a country. 6% band hai GDP ka. So you're not going to go to 8 suddenly, you're not going to collapse to 4. It's a holding pattern. Until we get this new stimulus coming in, that catalyst is required to kickstart. The government's played its part. You've got the fiscal stimulus.
Last time we spoke, you said you need this exact thing. I mean, you need a new source of wealth effect.
Yeah.
And maybe precious metals, I don't know. I mean, is that...
Well, one sector takes off and then that animal spirit spreads. Today...
that is missing.
It's like, the average industrialist is like, should I go in this direction? Should I go in that direction? Will policy change? What will happen? Will I get the support? I think stars are aligning. We just have to be patient, I guess. We can't have a bull market every single day of the year. Sometimes it's good to just pause and reflect after a good meal. 4 years you've had a good meal. Just do a detox for a while and then take it from there. This market wants to go up. We're not giving them enough reasons because that has to come from earnings. When you're doing a single-digit earning growth, you can't say at 20 PE we're like, okay market. Some earnings come and then we're off to the races. And it'll still be very specific. I don't think the tidal move across sectors happen. Because in typical periods like this, you separate the men and boys as well. Look, the US has 30% holding of treasuries by foreign governments. And with, unfortunately, the way they have gone and kind of rubbed all governments of the world the wrong way, do you think 30% of all the refinancing which is coming up over the next 12, 15 months is going to be attractive to foreigners to come in? At 4.5%, maybe you'll be tempted, but then you'll think, what if this guy confiscates my holding of treasuries? Because they've done that to other countries, which is why you've seen not just the bond yields here, but the flight of capital away this time. Number one has been gold. but it's also gone to euro. The Swiss franc is 1.2 to the dollar or thereabouts, which the Swiss central bank, I remember, was trying to hold it within parity for the longest time. The euro, which is actually, you know, we used to call them the sick man, and Larry Summers had this thing of Europe being the museum of the world. The euro is strengthening because that capital is going back, because they've clearly rubbed the Europeans also the wrong way. So I don't see an alternative for the US government, whenever this refinancing now starts coming up, to go back to anything other than printing. And that's the reason for what you're seeing is happening to gold, and why we think there is endemic inflation in hard assets. So when we talk about markets, the normal trend has been US weakens, money goes to emerging markets and hard assets. What Trump is doing is only accelerating a lot of these trends, which he also does want a slightly more competitive dollar. But if you get this rise in gold, silver, uranium, copper, whatever at one end, and real assets like factories and real estate, it's a decadal move. It's not a 2-month, 3-month kind of move. And I think you'll see substantially higher gold and silver prices.
Okay, so that's a big view coming in on the market and what this volatility, the whole tariff conundrum, what it really means for Indian equities. Let's move on and put the spotlight once again on the city gas distribution space. We told you earlier, so let's revisit that story. APM gas allocation for these companies is down by anywhere between 18 to 20% effective today, which is why in the pre-open session, I mean, you're seeing those kind of deep cuts on many of the stocks. So Darshan's here again to recap the details. So big cuts there.
So within 15 days of APM gas price increase, government has today announced APM gas allocation cut. While the gas price increase was as expected because it was as per the recommendations made by Krit Parikh panel 2 years ago. But this gas allocation cut has come as a surprise. Government has announced that APM gas allocation, which is cheaper source of gas compared to other gas because it's used for the priority regions, and it has been cut by 18 to 20%. In last 1 year, the allocation has been cut by almost 50%. In the beginning of 2024, total APM gas allocation used to be somewhere around in the range of 70 to 80%. Now it's reduced to 40%. What do brokerages say? CLSA feels that shortfall will be replaced with allocation of new well gas, which is priced 20% higher than the APM gas, and companies like IGL and MGL will have to take price hike that would be less than ₹1 to offset the higher gas cost. Jefferies believe that full extent of cost increase will unlikely to be passed on to consumers, and as per Jefferies, it builds in flat EPS over FY 25-27.
Okay, all right. Well, thanks a lot for that, Sir. Well, let's discuss more on the impact with regard to this lower APM allocation to the gas distribution companies. We have Sumit Pokarna, the Vice President, Fundamental Research at Kotak Securities, who joins in. Hi, Sumit. Good morning, and thanks a lot for joining in. Well, how does the news flow compare with what you were factoring in? Lower allocation, they'll have to source gas now at a premium of around 20 to around 30%. Your reading?
Yeah, thanks for a very good morning to all the viewers. Definitely, the domestic gas supply, or particularly APM gas supply, is reducing, and around 3 MMSCMD of gas of ONGC has been nominated as a new well gas. So from APM gas, so that means that much pricing will increase. Particularly if I talk what was happening, the APM gas is priced as $6.75 per MMBTU. However, new well gas is linked with crude oil price, which is 12% of the crude oil price. So the gas supply from APM to new well gas, and that will be supplied to city gas distribution companies. So this is a new normal according to us. You will see further cuts going forward from the APM to and moving to new well gas. So these companies have to adjust with the new gas allocation, and at the same time they need to increase the price. As per our calculation, they need to increase the price by ₹1.50 to ₹2 per kg for CNG. Going forward, given the threat from EVs plus the Delhi policy, EV policy which has come, we believe it will be difficult for these companies to maintain these high margins, and they will That's why we have been negative on city gas distribution companies, particularly IGL and MGL, who has got a higher weightage in this segment on the APM side. So we have been negative for last more than 1 year, and we have been recommending investors to move away from these two companies.
Okay, get your sense of caution. Sumit, what is the kind of margin hit that you're right now penciling in because of this lower share of APM? And then, like you're saying, they've not taken commensurate price hikes to offset the impact of the more costly gas that they're getting. So what's the margin hit for, say, an IGL or an MGL in FY26?
Yeah, so we believe if they can pass on the burden of this by 1 rupee 50 paisa to 2 rupees, they will be margin neutral. So we need to wait and watch how this happens, because there are political compulsions, there are EV threats, and there is a substitute product, petrol, diesel. So if you are increased price too much, then obviously the conversion rate of from liquid fuel to gaseous fuel like CNG will happen at a lower pace. So we need to wait and watch how does that pan out. But if they do a price hike of 1 rupee 50 paisa to 2 rupees, they will be good enough.
Wow, okay, 1.5 rupees to 2 rupees of a price hike will mitigate the impact. Got that. So let's see if the companies take that kind of a price hike or not. That's one part of it. And secondly, just to get an idea of the change in the feedstock now that they have to take gas from a lot of the newer wells, what is the blended increase in the cost of gas for these companies?
So that will depend on each company, because everybody has a different set of mixture. Gujarat Gas has got more industrial weightage, and they are dependent on more on international gas prices. However, MGL and IGL has got more domestic gas allocation, because their weightage more towards CNG and PNG, domestic, rather than industrial side. So it depends on which company we are talking about. Definitely, if you look at the substitute product, which is naphtha for Gujarat Gas, how the prices are trading there, they can still pass on the burden to the industrial consumers. Yeah.
Yeah. So, but IGL and MGL, you're saying that for MGL and IGL, the actual increase in their feedstock cost in you know the overall gas prices will be a little lower than for Gujarat Gas. Any rough estimates for MGL? Say how much does the cost of gas increase by?
No, what I'm trying to say is Gujarat Gas has got more industrial volumes as compared to MGL and
IGL, yes.
Yeah. So they are less immune as compared to with this new policy change which has come. So it all depends how they will increase the prices, and they can pass on the burden to the end consumers.
Okay, so basically you're saying stay away from all three, right? Avoiding all the...
As I mentioned, being a B2B, it is easier to pass on the burden as compared to B2C, given the current political scenario plus EV threat and other things. So if your industrials are concerned, you just need to see how the naphtha prices are moving. So Gujarat Gas, we are not negative, but IGL and MGL are negative.
All right, we'll leave it there. Thank you very much for joining us. Good conversation as always, and speak again soon. Let's talk about 9-10 calls. Sudarshan is here. Mitesh is with us as well. Sudarshan, what do you have?
We considered for buying, buy Chola Finance with a stop under 1528.
Okay, Chola Finance. Mitesh, what about you?
Adani Energy Solutions, buy above 891 for targets of 945.
Okay, all right. Let's revisit IndusInd Bank now. So, of course, I mean, that auditor's report was out, and we have some source-based information now on this as well. Stock was, of course, the top nifty gainer yesterday, about 7% high, starting about 1.5% up this morning again. Ritu, take it away.
Well, Prashant, there is a top-level shakeup. We understand that could be on the cards at IndusInd Bank, with sources indicating at least 3 senior-level exits expected in the coming months. Now, we've been given to understand that this includes the CEO along with the deputy CEO who was in charge of global markets, and that includes the derivatives portfolio. And this is because the regulator has expressed displeasure at the manner in which the entire issue was handled and the delay in disclosures by the bank. Now, while the board is already working on the CEO succession plan, we've also been given to understand that the regulator has asked the bank to submit the shortlisted candidates at least 4 to 6 months before the current CEO Sumant Katpalia's term ends in March next year. However, in its response to our story, the bank denied receiving any such communication and did not comment on the management changes. The bank has also now received this external auditor PwC's report on the derivative portfolio, which pegs the hit at about 1,979 crores, broadly in line with the management's own estimates as well as the street's expectations. And we also understand around the regulator's preliminary assessment of the hit. Now, the bank had initially pegged the adverse impact at 2.35% of its December net worth, which it has now revised down to 2.27% on a post-tax basis and will reflect it in its FY25 financials. So no nasty surprises on the financial front, at least. Brokerages like Morgan Stanley say they are going to closely monitor the upcoming earnings for more insights into the outlook. Macquarie sees this as incrementally positive in the near term, while Citi says developments around the CEO transition will be closely monitored.
Okay, all right. Got that. Ritu, thanks very much. So IndusInd Bank on the radar as well. Pre-open suggests that it'll start maybe 1.5% on the higher side. Finally, as we're getting set for market opening, the Nifty is very, very quiet. So the implied open seemed sort of a little, perhaps too optimistic, given that the nature of global markets is once again a little jittery at this point in time. Asian markets, I'm just recapping the global screen as well and just going back to see what US futures are doing. US futures are still down. Nasdaq futures are still down about 1.5% because of this Nvidia impact. And because of that, Asian markets in general are not in great shape. Hong Kong is down 2.5% right now, which explains that we'll have a very quiet opening. So I guess, Prashant, if we at least hold our own, retain some of yesterday's gains, I guess the bulls will take that as well.
No, absolutely. And, so slightly quieter and calmer markets needed the hour. Let's see if we are able to get that. 23,344 is where the Nifty is at. It's been frantic down and then very, very fast climb back up as well. So we are basically back at levels where we were on the 1st of April before those reciprocal, so-called reciprocal tariffs were announced on the 2nd of April. And just been some absolutely historic price moves for markets here. Not so much here, but actually around the world, especially in the US and other places. So the first trade should come up on your screen, and we'll look at what the open is going to look like. We'll do, of course, indices first, and we'll look at specific stocks.
All banks, by the way, IndusInd, HDFC, Axis, it's just banks charging away this morning as we open.
I think that ICICI Bank 25 basis point deposit cut is important because, I mean, that is the cost, right? And they are effecting a deposit rate cut effective today, and that's one of the leaders. 15 points lower is what the Nifty is indicating. The sensex is down 30, so this is neither here nor there. It's kind of flattish, in the flattish zone. The bank Nifty is up about 0.25%, 52,490, 52,500 actually is where the Nifty bank is at. Midcap index is flat, and I think you've got a small cap index will come up on your screen, which is also largely flattish, nothing, almost unchanged at this point. Nifty heat map gives you a quick snapshot view. What do we have? It is more down than up, certainly. Banks are on the sort of top end in terms of what's doing well. On the other side, it's basically a plethora of things. It's a very, very mixed start. Surabhi.
Okay, by the way, there's some breaking news coming in on CNBC.com that China has replaced its top trade negotiator to try and circumvent this absolute roadblock of a negotiation with the US. So keeping an eye out on all the global developments as well. But for the time being, let's look at what's taking the market lower here. Maruti is down about 1.5%. It's the weakest stock on the Nifty right now. Tech is weak. Infosys is down. HCL Tech Mahindra, Wipro, which is reporting numbers. All of the tech stocks are lower. Zomato, which is now known as Eternal, the listed entity, 1% lower on that stock as well. Reliance is not helping the bulls' cause today. Also putting pressure on the downside. Global-facing stocks. Basically, global-facing stuff is weak today. Tata Steel, Hindalco, IT, like I said, all of these stocks are on the lower side. Now, what's the counterbalance? It's financials, as we've been pointing out. HDFC Bank, 0.6% higher. Kotak Mahindra Bank, Axis, 0.5%, 0.25%, these kind of gains. I mean, the banks are not charging away, but they're at least preventing a wider fall. ICICI Bank itself is also trying to hold on to a gain of about 0.25%. So basically, it's a bit of a risk-off sort of a market. There's some buying on lever as well. Asian Paints, ITC, very close to the flat line. So basically, risk-off, going back to a little bit of the conservative side of the market. That's what's going on. And Eicher Motors, by the way, is the top winner on the Nifty for the time being.
Well, IREDA as well is higher in today's trading session. That's spiked up in trade. Yesterday had a good close to trade. There'll be a Gensol hit that will come, but that'll be in the following quarter, I think. So for the time being, the street has read those numbers positively. EPAC Durables, that's another stock that's opened high with a gain of close to around 4% or thereabouts. A good move. JPM Auto, that stock is flying away. It's up close to around 6.5%. So big up move is what we're seeing on that particular name. And on the flip side, you have Goldia. That's cooling off a little bit. Remember the last few trading sessions, that stock has seen a big run. So we have Goldium that's cooled off a little bit in today's trade itself. Keep an eye out on some of these textile companies because the Bangladesh has banned import of yarn from India through all land ports. So I think Vardhaman Textiles is one stock that could get a bit of a hit out there. For the time being, I think the stock Vardhaman Textiles, let's get that stock up for you. Nitin Spinners as well as another one that could get hit a little bit, a mild hit out there, just down 1% or thereabouts. So stocks not really reacting to that piece of news for now. But the Nifty Bank, that's the one that's leading the way in today's trading session, up close to around 150 points or thereabouts. The big winner from the F&O stocks, ICICI Prudential, up 3.5%. So that's the big winner. And on the flip side, if MGL, that's the biggest loser because of the APM gas cut. They'll have to source their gas at a higher price. That's why Mahanagar gas is down a good 5%.
And IGL as well. IGL is down about, MGL of course much larger cut. IGL is down about 1.5% as well. What else? I mean, Infi is the biggest volume-led loser. It's down about 1% right now. There's Mazgaon, which was a big winner yesterday, is down about 1%. Small moves. ICICI Lombard is a bigger one, which is down about 3.5%, 4%. As I said, we'll have the management up with us at 9:50. Zomato Eternal is down about 1.25% or so. Maruti is down 1.6, 11,660 on Maruti. Amber, Sun Pharma, Sai Life was a big, I think, 10-15% mover yesterday. That is coming off a little bit, 3.5% right now. These are just reversals. I mean, Home First was up, I think, about 6% yesterday. It is down 2.5-3% now. Kaveri Seed was a 5-6% mover yesterday on the upside. It's down 3% right now. So this is just sort of a bit of a flip-flop after the very large gains that we saw on many of these names coming through today. Apart from that, I mean, not very much. We've mentioned, I think, bulk of what is happening and bulk of what is moving out there. Well, let's welcome in Manish Chokhani, Chief Executive Officer, Emmer Capital Partners. Manish, good to have you here. Thanks very much, as always, for your time. You know, as Manish Chokhani said, and I think it's a general feeling, right? Just look at the price action here. The market wants to go up. You can feel it. But there aren't enough triggers, I guess. And of course, I mean, there's a problem of valuations and single-digit earnings growth, etc. as well. But what's your sense, Manishi? Markets, I mean, I'm talking about India here over the next few months.
What you said almost hits the nail on the head. You know, it's the situation right now is that valuations are, I mean, they have no doubt declined over the last 6 to 7 months, but not really as cheap as investors would like them to be. And at the same time, the bigger concern is that earnings growth, earnings estimates are still declining. You know, in fact, there was a small uptick to the consensus EPS estimates for both year 25 and year 26. But when the present earnings season, the result declaration season started from the first week of April, they have the earnings estimates have started declining again. And I think that for India, rather than the global noise that we are seeing, is possibly a bigger concern. And and that's why I said just about a couple of weeks ago that I think Indian investors would have to wait. They have to brace for another leg down during this earnings season. At the same time, if one looks at the long term, India is clearly better placed than many of the Asian peers. After all, a 10% tariff is better than 26% of tariff. And at the same time, as a consequence of this global reshaping of the supply chains, that's kind of inevitable now. We will almost certainly see more of what Apple has been trying to do. So it is over the long term, not so dismal a picture, but in the near term, we have to brace for more valuation correction and more earnings estimate decline.
Okay, so earnings will continue to be a reality check. Got that point. Manish, just give us 1 second. I wanted to look at two stocks, JBM Auto and Electra Green Tech. Nice surge on both of these, 4.5% to about 7% on JBM right now. Electra is up about 4.5%. There's some buzz about a large order, electric bus order, could be as big as 10,000 crores. And of course, these companies manufacture e-buses. They're part of the supply chain. So perhaps there's some excitement on who gets the win, if they get it, if Tata Motors gets it. So worth putting that out. But Manishi, to get back to the point that you're making, that earnings continues to be maybe our Achilles heel. But isn't the fact that the fourth quarter is also sort of, it's going to be maybe muted, maybe not as bad as Q3, isn't that already in the price? And what are the numbers that you have in mind? I mean, how will we end Q4? The projections for next year talk about maybe, 10 to 11% earnings growth. Do you think that will actually happen?
10 to 11% for next year, which is fiscal 26, is kind of reasonable. But many of the earnings growth estimates that I'm seeing from consensus, if you look at Bloomberg or FactSet, they're actually in the mid-teens even now. They're in the 15, 16, 17% range. And I think those estimates will have to come down. Which are the sectors that would suffer? I think, consumers, particularly consumer staples, these companies are constantly, in each and every quarter, they're postponing their turnaround target. I hear analysts asking the companies, when do you think your earnings environment would bottom out and demand would, gradually begin to come back? And almost in each and every quarter over the last 2 or 3 quarters, I'm seeing that it's going to happen in the next 2 quarters. And that timeline keeps on shifting. So that would be clearly one sector where I would expect earnings estimates to come down further. Second, IT services. Even though services sector has not been hit by the Trump tariffs, there is a clear wait and watch environment among the U.S. corporate investments. So, investors or rather the corporates are not really willing to invest more in either capacity expansion or improving productivity through tech investments. And that's not good news for IT service companies. As these results come out, as we get more and more commentaries from the IT companies, I would almost certainly see another leg down in their EPS estimates. I would think that even some of the domestic sectors like industrials, consumer discretionaries, you would have earnings estimate downgrades, partly because those earnings estimates have not been downgraded to the full extent that they deserve. But honestly, I think the domestic sectors are possibly close to the end of their earnings estimate downgrade cycle. Now we have to be more careful about the globally linked sectors like IT, like metals, like some of the pharmaceutical companies and so on.
Just to recap that, Manishi, so you're saying downgrades in IT and in consumer discretionary, those are the big ones. Right. Where else will you see, or are you expecting big downgrades?
I would expect some of the other globally linked sectors also, let's say metals or other materials. So these 3 or 4 sectors put together is almost about 40% of the total Indian earnings, the earnings profile. So that is, those are the sectors that I would be more concerned with.
And do you feel that this reality of lower earnings, do you feel that it's not adequately reflected in stock prices in the market level right now? So there's a downside risk to the market. Is that what you're saying?
Yep. In fact, as I said, that if you look at the consensus estimates for the market as a whole, for most of the aggregators, it is turning out to be about 15 to 16% for both fiscal 26 and fiscal 27. I would expect at least the fiscal 26 number to come down to just low teens or early double digits.
Okay, all right, Manishi, appreciate you joining and thanks a lot for giving us your view on the markets. We look forward to having a longer chat with you in the next couple of weeks. Well, time to get to an exclusive chat now. We are now joined by Mr. Sandeep Pondrik, the Secretary, Ministry of Steel, who joins us on the show. Hi, sir. Good morning, and thanks a lot for speaking to us here on CNBC-TV18. And before I move forward, I just wanted to compliment you as well as your team. You all were rallying for some kind of protection for the steel industry, and very rightly so, going by the kind of uncertainty we have in the global backdrop. And this is the second time I've seen in the last 10 years or so that you'll have come in there and helped the steel industry. I recall the MIP that was imposed in 2015, and now, in fact, the safeguard duty as well. So good going on that front. But, sir, we have a couple of questions on that front. When does the safeguard duty of around 12% take shape? When does it get implemented? Point number one. Point number two is there are various rumors and murmurs that maybe, in fact, that safeguard duty could move up to around 20%, purely going by the kind of uncertainty, kind of dumping we're seeing from the Chinese. Is there a possibility for it to move up?
So, thank you and good morning. On the first question of safeguard duty, when it is going to be implemented, as you know, DGTR has given its recommendations. They are in public domain. DGTR has recommended 12% safeguard duty on certain products and with caps on prices of those products. That recommendation is under examination in the government. I think in very near future a final decision will be taken on that. I really can't give you a exact timeline, but my expectation is in near future a decision will be taken on that, so we can expect that. On your second question, point about 20%, I really don't know, because it's a, as you know, the DGTR process, the safeguard duty imposition process, is a sort of a quasi-judicial process, and DGTR has heard everyone, asked for objections, and after that they have recommended this safeguard duty. So I think when the decision will be taken, DGTR's recommendation will be the main basis on which the decision will be taken. I don't see any reason for the rumors about 20% safeguard duty.
Okay, all right. Thanks for clarifying that, sir. But near future, could you quantify it? Should we work with 45 days to 2 months? Would that be a fair estimate? Within this time, we should see the implementation?
You know that I really can't give you exact timeline, because it's not the Ministry of Steel which will take a final decision. It's the Ministry of Finance in consultation with Ministry of Steel and Ministry of Commerce and everything. So I really can't give you a exact timeline for that.
Okay, all right. But at least you're clarifying that as of now, we should be working with that 12% mark itself. Those rumors of around 20% for the time being, that they don't have any merit. What about steel consumption, sir? That's been quite strong in India.
Yeah.
The globe has been in a tizzy, but steel consumption here in India has been good. 9 to 10% in an environment that was rather brittle. For this year, what kind of a number you're working with in terms of steel consumption growth?
So I totally agree with you on that. In fact, India is the only country, only major economy where steel consumption is growing in double-digit numbers. If you actually see the data, in 2020-21, we were 95 million tons, increased to 105 with 21-22, 22-23, roughly 120, 23-24, 136, and this year it is 151. So we are growing for last 5-6 years at least for in double-digit numbers, while the world steel consumption is roughly 1% or even less than that. In all the major economies, the steel consumption is either stagnating or going down. So India is the bright spot in terms of steel consumption, and we expect that this will continue, especially in view of the fact that Number one, government spending on infrastructure is sustained. Government is pushing infrastructure. So more than 1 lakh crore last year, more than that this year on infrastructure. Then other government programs on roads, bridges, housing.
Yes.
Add to that the private sector development in real estate and other fields. So we expect that for next few years we will continue to grow in double-digit numbers. That's what our assessment is. And to match to that, we will need to have the production capacity.
Sure.
I would also like to point out one more thing which I have stated earlier, that the per capita consumption in the country now is more than 100 kgs per person. And it has been seen with respect to other countries that when a country goes at this level of 100 kgs per capita consumption, then the elasticity with respect to GDP growth rate increases. So till now it is 1.2, 1.4. Now I expect that the elasticity will be more than 1.5. So even if with that, if you see our GDP growth rate around 6.5 or so, then the steel consumption should grow about 10%.
Okay, so above 10% growth in domestic steel consumption. Got that point, sir. But sir, just to revisit what you said earlier on the safeguard duties, and you were telling Nigel that you don't see much merit or any reason behind these rumors of expecting 20% safeguard duty. If I could just press on that point a little bit, when the safeguard duty calculations happened and the industry had made its case with the government, this was the US liberalization day era, where anyway companies were talking about dumping happening from China and allied countries like Vietnam, etc. In this new reality where there is a tit-for-tat fight between China and the US and tariffs are as high as 145% on China, will 12% safeguard duty be enough to offer protection to the Indian industry? Because there's a huge fear of additional dumping through some other routes, circumvention, maybe not directly from China. Will 12% be enough, sir?
So let me say what has been the import in last year. If you actually see the import data for 24-25 as compared to 23-24, the import has increased by roughly 1 million ton. So it was roughly, I would say 8.3 in 23-24. This year it has been 9.5, so 1.2 million ton increase, which is about 14% increase. And most of that increase has, the bulk of the increase is from Japan, not from China. So if we actually see the import data, China, Korea, etc. are more or less at the same level at 23-24. So I don't expect any major import increase because of the present scenario. Also in view of the fact that in addition to safeguard duty, we are also trying to see that misuse of licenses doesn't take place. We have got complaints that in certain cases and in certain countries, licenses are being misused by importers and exporters both. So that is under investigation, and we would try to put a stop to that kind of practices. So it's safeguard duty, I don't think is the only way to protect the domestic industry.
Mr.
Other ways of ensuring that the proper procedures are,
Yeah, sorry, I completely take your point. Good morning, Prashant here. In what way, sir, are these licenses being misused that you are sort of looking at?
So basically,
just to illustrate an example, with an example,
they are still under investigation. So just to get an example, basically what we are getting complaints is that if a particular license is with a licensee in a country, then multiple factories or multiple units are using that license to export steel to India. So suppose legally only one person to whom the license has been given to the entity, they can only export, but we have got complaints that malpractices in that respect is happening, that people are using that license to export to India. So similarly, the other example is where misclassification of products. We have got complaints that misclassification or wrong classification of products is being done to get out of the BIS and QCO requirements. So we have got those complaints. We are investigating them. We will try to plug those loopholes also, so that these kind of things don't happen.
Right. Mr. Pondrik, just to press on the earlier question, I think you made it clear, but allow us one more attempt. Not on the rate of 12 to 20%, but do you reckon, because I mean the US-China thing looks like a very, very protracted thing. Our imports were only about 3 million tons from China. But the point is, it could be, more steel could come from other locations. So are you worried about that? And also, will more products need to be covered under these kind of safeguard duties, stainless steel, etc.? Or you think that's not necessary?
For now, I will stick with what the DGTR recommendation is, and if we see in future that what you are seeing is taking place because of the present situation, if there are any changes, then government can always have a relook. So that option is always open. But for now, I don't see any reason to have a relook at that for the now. On the product side, stainless steel, I don't think there is any application filed by stainless steel industry. As you know that for safeguard duty, the industry has to file a application with DGTR. So if the industry files, then the process will be undertaken by the relevant authorities, and government will take a decision on that.
Mr. Pondrik, just to clarify, final on this tariff point, can you tell us if in the last couple of weeks you've received any fresh applications from industry to consider a duty even higher than 12%? Or can you confirm if the DGTR itself could be thinking of maybe revising its suggestion of 12% as of now?
I can't comment on behalf of the DGTR because that will have to be answered by DGTR. In the Steel Ministry, we have not received any such applications for increasing from 12 to 20%. DGTR, you will have to ask the DGTR whether they have received any such applications.
Okay, all right. When I speak to some of these steel producers, they said the higher the better. But as of now, you're saying you've not heard it. So maybe, in fact, that's not yet reached your ears. For the time being, we'll work with 12%. Let's get a couple of quick pointers out of the way, sir. There was talk of this mega merger, NMDC Steel, SAIL, as well as RINL. Is that on the cards or no?
RINL, as you know, that government has given a lot of money to RINL to keep it as an ongoing concern. So I don't see any possibility of immediate merger. That decision is not there in the government. Similarly for NSL, so for now, no such talks are, or no such thing is happening in the ministry for merger of these three.
Okay, all right, and no merger as of now between these three. Also, any plans to divest NMDC Steel? Has that moved forward?
As you know that the 21 decision of cabinet that NSL will be divested still stands. However, not much progress has taken place on that front. That process is undertaken by Department of Divestment, as you know. So DIPAM is the responsible department for that. As far as our information is, not much progress has happened. because of various reasons, including local resistance and all of that.
Okay, got it. All right, very quickly, sir, before we let you go, what about Ireland conversation with the Karnataka government? They wanted to push through that bill, which is going to be increasing royalties to a very, very large rate. There's been to and fro. I believe that it's not yet got the green signal. Are you all in conversation with them for a more rational rate out there? Because otherwise it will make mining unviable for a lot of these miners.
I agree that if we increase the taxes or royalties or whatever on iron too much, then it will have an impact on the mining industry. Also that cost of iron ore in the country is already not very low. So if we increase that, then it will have its consequent impact on the steel prices also. As far as the talk with Karnataka government is concerned, that is being led by the Mines Ministry, because they are the nodal ministry for all mines, and the bill which has been brought by the government. So Mines Ministry is talking on behalf of Government of India,
right?
Both in the legal system as well as with the state government.
Got that. Thank you so much for providing all that clarity, Mr. Pondrik. Really appreciate your time here on CNBC-TV18, and we look forward you're able to join us more frequently to touch upon the important sort of issues with regards to the sector. Thank you very much indeed. We'll take a quick commercial break here. Markets have recovered a little bit. We're up about 25 points from being down a little bit. We come back and we put the focus on the BFSI space. We'll get you expectations. Abhishek is standing by with that. Quarter se quarter tak. Back in 2.
Welcome back. It's time for our special offering, Quarter Se Quarter Tak, where we bring you key expectations from the quarterly earnings. Abhishek is joining in with the expectations from the banking sector in Q4. Abhishek.
Well, to begin with, business momentum of banks have softened quarter on quarter in Q4 FY25 versus Q3 FY25. So take a look at the deposit growth. At the end of the fiscal, deposit growth was around 10.25% YOY and about 2.3% sequentially. Q3 FY25 deposit growth was around 2.6% quarter on quarter. Now, advances growth rate have softened to 11% YOY and about 2.3% quarter on quarter as of FY25. Loan growth, however, continues to remain higher than deposit growth rate. So this compares to a growth rate that you saw of 11.2% YOY and about 3.6% quarter on quarter in Q3 FY25. So business growth rate of lenders have softened at a time when interest rates on liability side is at the peak or of the businesses at the peak. Hence, we can now see the beginning of cyclical pressure on net interest margin of lenders. Now, analysts do estimate that the net interest income growth to be sluggish in this quarter, especially for PSU banks. Now, PSU banks have largely raised deposits as a higher cost, while their loan growth is lower than the industry levels, is what analysts estimate. Credit deposit ratio, as a resultant of higher loan growth than deposit growth, the industry has witnessed or seen a credit deposit ratio at an all-time high of 80.8%, which reflects a more aggressive lending stance from the lenders. Now, this augurs well for some of the lenders to maintain their net interest margin at healthy levels if they are able to curtail their slippages. Now, credit cost for this quarter, certain sectors, especially those with unsecured lending like microfinance, are expected to face higher credit costs in Q4 FY25. Slippages for the banks could be on the higher side quarter on quarter, which could lead to higher provisioning requirement and thereby impact the earning capability liquidity of the lenders. Now, with respect to asset quality, while asset quality is generally stable, concerns will remain around the unsecured lending portfolio of lenders, which are expected to witness continued deterioration like they did in the previous quarters. So, analysts do estimate higher slippages for the banking sector in Q4 FY25 versus Q3 FY25. With respect to earnings outlook, overall, the earnings are expected to remain weak, particularly for PSU banks, largely due to lower net interest income growth as well as lower treasury gains for some of the lenders. Higher credit costs can be seen for some of the lenders, thereby impacting their earnings momentum. Overall, earnings are expected to see weak momentum for the banking sector in Q4 FY25. Now, we do have some of the key estimates from Kotak Securities. For SDFC Bank, they are expecting NII growth to be about 8% YOY, while PAT growth to be about 5% on a YOY basis. For ICICI Bank, the NII growth is expected to be at 8% YOY, while the PAT growth also to be at 8% YOY. For Axis Bank, Kotak Securities estimates NII growth of just 4% YOY, while profits can decline 7% YOY. For SBI, they are estimating NII to decline by 2% YOY, while PAT can decline by as much as 43% YOY and more than 30% quarter on quarter. For Bank of Baroda, Kotak Securities estimates NII to decline by 3% YOY, while PAT to decline by 16% on a YOY basis. Back to you.
Okay, all right, Abhishek, thank you very much for that. So getting set for the Q4 financial earnings season. To talk about this, we've got Santanu Chakrabarti, India analyst at BFSI at BNP Paribas, joining in. Santanu, great to have you on. It's all eyes on financials. All hopes are now resting on big banks and NBFCs in the market, and we're seeing that in stock prices as well, right? The question is, will earnings match up? Your opening thoughts.
Right. I mean, it's very clear to us that this quarter marks the bottom on earnings growth for the sector, right? Maybe not the bottom for margins, which is one quarter further out, given the rate cuts and all of that, which we had expected. But earnings growth from here on out by the middle of the next financial year is supposed to reach from negative territory into mid-teens. And therefore, what the market will be more focused on is not the known fact about what the balance sheet growth looks like for each of the businesses, or the fact that, next quarter there'll be a margin hit. I think investors will focus a lot on what's happening on the growth outlook front. And this especially becomes salient in the context of the liquidity support that the RBI has been providing. And if RBI was to be backstopping all liquidity impact of foreign selling, then from that onwards, we would expect some acceleration in both loan growth and also commensurately deposit growth. Because, if money is not leaving the system by means of current or capital account, then, every rupee of credit growth will translate into a rupee of deposit growth. So that's what the setup is, which is why I think, the outlook provided by the banks and what could be perhaps the first set of, constructive commentary on growth in a long time would be the key determinant this result season.
So to put that in some broad numbers, Shantanu, let's say if I decide or anyone decides to buy large cap banks as of now, and I'm talking not Q4, I'm saying FY26, what is the kind of growth in the book that one would be buying at current prices? And even margins, while I take your point that, the margin recovery could be some time away, look at what banks have done. HDFC Bank, ICICI Bank, they're already announcing a cut in deposit rates. It's happening really quickly, the transmission. So that perhaps is better than what the market would have hoped, because usually deposit rates are lowered with a lag and therefore you have that pressure. So give us a sense, next couple of quarters, anyone who's buying banks right now, what kind of growth and margin outlook are they buying into?
Right. I mean, Suri, extremely pertinent observation on your part. And I think the next leg of that trade is clearly current account and savings account starting to pick up. Especially, Surbi, you hear this very often talked about that the reason that current account balances in the last 3 years have not really moved for banks is that because the government has got more efficient at managing its day-end balances and so on and so forth. Now, if you look at the gap which has opened up, that cannot be explained by that phenomenon alone. I think if you dig a little deeper, you'll see the main reason,
that current account has lagged in India over the last 3 years, lagged the growth in money supply and deposits, is because, businesses in India, frankly, have gotten more conservative on their cash cycles, which is basically that the working capital cycles for businesses in a period where money markets have remained tight, in a period where credit policy from banks has been tight, have got extended. So the amount of, say, check values that clear on a daily basis have gone down, which essentially is the current account balance. Now, the good news around that is if businesses get more confident with, say, getting money from a CP at the end of the day, or if they call their bank for a OD extension, it's going to come through, then automatically their payment terms start to get, better. And that has a ripple effect through the system, and current account balances will move up again. So, what you're seeing in terms of rate cuts, or HDFC making a statement by taking its, savings rates to 2.75, just 5 basis points north of SBI, all of that is just beginning of the easing cycle. And I completely agree with you, which is why we are very constructive on FY26 earnings growth for banks as a whole. The only headwind that we see is that from slightly low levels of credit costs that some banks have in this financial year, the next year you might see some normalization. But it won't dull the overall earnings picture.
Okay, Shantanu, just got 10 seconds left on the chat. Since you're very constructive on banks, give us the top picks.
Topics are HDFC, ICICI and Axis in that order. Of these, ICICI stands out in a slightly different way in that if the rate cut cycle doesn't pan out, or the acceleration that we are talking about doesn't pan out, is the least impacted amongst the three.
Okay, all right. Shantanu, a good conversation. Thank you very much for joining us and sort of getting that perspective. All right, ICICI Lombard is the next company that we're focusing on. Net earned premium has risen by 20% year on year. Underwriting losses have declined. Combined ratio is looking a little better. Let's bring in Gopal Balachandran, Chief Financial Officer at the company, who's with us now to take some questions. Gopal, good morning. Prashant this side. So for FY25, gross premium grew 10%, net earned premium grew 17%. Can FY26 be a better year on both these fronts? And what is the growth that you're baking in on these two matrices for the coming year?
So good morning, Prashant, to you and all of your viewers. So let me just kind of put this in context. I think when we started FY25, what we had kind of talked about is from an ICICI Lombard standpoint, we expect to have an outperformance with respect to top line growth. And that is exactly what we have been able to end the year with. I think the industry grew at about 6.2%. And on a gross direct premium basis, ICICI Lombard has grown roughly 210 basis points ahead of the market. And pretty much on expected lines, I think even on the combined ratio front, as you rightly mentioned, I think the trajectory is something that we have been able to see an improvement getting delivered. And more importantly, the return on equity range that we had been talking about between that 16 to 18%, I think we have been able to kind of pretty much live up to the expectations. Now to your point on how do we see things playing out for FY26, I think across different segments, I think the road that's kind of laid down looks very, very promising. Whether you look at the infrastructure investments and logistics coming in on the commercial lines, pricing uptick again happening in that segment, health looking quite promising, continuing to look to exhibit a double-digit growth, and even motor, I think in terms of how do we see things playing out in the subsequent year, looks promising. So all in all, I think what we would kind of continue to pencil in is to outperform the industry in that range of, as we keep saying, between 200 to 200 basis points insofar as top line is concerned, and obviously a trajectory to see an improvement in combined.
Sorry, 100 to 200 over industry?
That is correct.
Okay. On combined ratio, Gopal, you managed to protect the 102.5 level. Will it get difficult to improve from here on? And could you specifically give us what are you looking at for 26?
So I think directionally, Prashant, obviously what we have been able to deliver is a consistent improvement in combined year on year. That's what we had kind of spoken about as well. And even in fact, at the beginning of the year, honestly, if you look at in our April 24 earnings call, we did kind of expect the market to be slightly more semblance insofar as combined ratios are concerned. But If you look at the 9-month numbers, the industry has actually seen an adverse development in the overall combined. In fact, it has kind of moved by about 100 basis points from 112% the previous year 9 months. So the key thing to watch out for is what direction does the market take, and in that context is how we will be kind of positioning our opportunities. But everything remaining the same, definitely we would want to see an improvement in the combined going ahead. And more importantly, as I said, the return on equity range that we want to continue to start exhibiting to the stakeholders will be within that 18 to 20%.
Gopal, I just want to focus on the motor segment a little bit because some of the broker notes this morning are pointing out how the growth in motor is maybe, a little soft compared to what the expectations would have been. One, obviously, it's a straight function of sale of new vehicles, and those numbers have been a little weak. But also, what are your expectations from that business? And are you expecting an increase in the motor third-party rates anytime soon?
Yes, Surbhi, good morning to you. I think let me answer the second part first. I think third-party is something where for a reasonable number of years, I think there has been, in that sense, not a price increase that we have seen. As an industry, I think we have made representations to the regulator who, in consultation with the government, kind of notifies the price change. Thus far, we haven't necessarily heard anything from them so far. But obviously, as I said, we have made the right representations. And in case if the final notifications comes through with a price change, that's augurs very, very positive, both for the industry at large and specifically in the context of ICICI Lombard, it will be a great, great positive. But to your first point in terms of how we see the motor segment play through, again, let me just put this in context. If you look at the current year, I think the key that we kind of keep watching for is, can we continue to outperform the market? If you look at it on a full year basis, the industry grew on motor roughly at about 8%. ICICI Lombard's growth was roughly at about 11.5%. So we were able to accrete market share. Your point is right. In some sense, there has been a bit of a slight slowdown insofar as new vehicle sales is concerned. But obviously, I think when you look at in terms of some of the actions that the government and the regulators have taken to kind of spur demand on ground, seems to be quite promising. And therefore, to that extent, we do expect new vehicle sales to come back, at least when we look at FY26. But more importantly, for ICICI Lombard, one of the areas that we have actively focused on is to see how we can significantly improve our existing renewals of the book that we have already underwritten. So hence, quite promising and a lot more optimistic.
On motor third party, you're saying industry has made representations and you haven't heard anything as of now. What is the kind of price hike that industry is seeking in motor third party? And also, if you could give us some sense of the loss ratios there, because if that third party price hike doesn't come through, it's going to weigh on profitability, isn't it?
Yeah, so let me just again put this in context. When I said that we expected at the beginning of the year semblance to come in the market, it was also in the context of motor as a line of business. And as I said, we have the numbers for the 9 months. So if you look at the industry combined ratios on motor, this of course includes both own damage and third party. There, the combined ratios have actually moved more adverse. It has moved from 118 to 123. So hence, therefore, is where we are all kind of coming from to say that it's been 3-4 years of, let's say, no price change in the context of third party. Any kind of a price increase coming through, I think we will be very, very positive at. What that number could be, I think we will leave it for the regulators and the government to kind of decide in terms of what they eventually give out. But the good news, the other aspect that we would be kind of very, very closely watching for, Surbhi, is next year, which is FY26, happens to be the year when the IREDA defined threshold on expense of management, wherein companies are supposed to kind of meet the threshold of expense of management to be within 30%. ICICI Lombard has always been within 30. Many companies have been exceeding that threshold. So if we see some discipline coming through with respect to the expenses of management, that will be a lot more positive as well in terms of how demand could kind of spur insofar as the market is concerned.
Since you brought up that point, Gopal, I must point out that our colleague Yash, who obviously covers the insurance space, you know him well, he put out a story a couple of weeks back on this business of expenses of management, that maybe the regulator could consider individual specific caps on commissions in order to, quote unquote, kind of discipline the industry, because the regulator seems to be feeling that lower commissions are not being passed on in the form of lower premiums to the customer. Just your thoughts on this, if you've heard anything, and what will this mean if there is a specific individual cap on commission, not the total expense?
Yeah, so I think, so again, Surbhi, again, just put this in context. I think the regulator has been very, very at it to make sure that as an industry, companies kind of toe the line insofar as the expense of management threshold is concerned, which is why they gave that 3-year glide path for players to kind of work towards. As I said, FY26 is the year when you would see those companies having the need to kind of come down within those. So that will be a key regulatory watch in terms of how companies exhibit that trajectory.
Gopal, the point is overall cap is fine, but there are commissions and there are operating expenses. Problem is, IRDA feels that commissions are through the roof. And that is, so is that a problem if it happens?
Yeah, so which is what I was kind of responding to, as in to say that I think one of the things that the regulator will be closely watching for is this threshold in terms of how companies are navigating. So long as they are able to see the direction of change in terms of companies going down in their overall cost of distribution, of which a very large proportion of which will also be the acquisition cost that they kind of exhibit to distributors, and that will be a key positive. So hence companies will have to actively work to make sure that they bring down their overall cost of distribution, that specifically in the context of commissions, at least in the context of ICICI Lombard, which is what I was talking about. I think we are very, very clear that insofar as the overall expense of management is concerned, we will be well within the norms. And two,
have you
and individual commissions, cost of acquisition of new business, where are you at right now?
So again, let me just put that in context. Even when the regulator kind of introduced these guidelines on long-term policies, which came into effect from October 1, clearly the intent from a regulatory standpoint was to try and see if we can get the cost of acquisition amortized over the contract period. From an ICICI Lombard standpoint, clearly we have stuck to it to make sure that at least insofar as the cost of acquisition for long-term products are concerned, it gets kind of remunerated over the contract period. So that's how we are focused on, and making sure that we kind of well operate within the laid down guidelines that the regulator has put in force.
Have you heard? The story was put out about a month ago. Have you heard from the regulator? Has there been any interaction on commissions in the last 1 month for the industry, not just you?
Yeah. As I said, the regulator is very closely watching this particular space, and I'm sure we will wait for any further actions on that.
Okay, all right. We'll leave it there then, Gopal. Thank you very much. Appreciate you joining us and running us through the results, and of course that 18 to 20% ROE guidance, which I think is a bit of a bump up as compared to what they put out earlier. I mean, overall, directionally, things are looking positive. Stocks recovered quite a bit from the day's low. I think started about 3.5 lower, is down 0.8.
On the commissions, if I got him right, reading between the lines, I think the status quo is, Karo nahi to hum karenge. That's what the regulator is doing in this consultation and wait and watch period.
That is what Yash's story essentially was, that it was a warning to health and general insurance against rising commission payouts. All right, well, let's just go back to the market for a little bit. Mitesh is back with us with a quick check on how he's looking at things. Looking much better, 35, about 40 points higher, 23,366. Mitesh, what does one do?
So Prashant, we talked about buying any kind of declines. I think the gap down was immediately bought into with the bank nifty leading from the front. So I think that's where some trading opportunities can be identified. I have Bank of India as a buy recommendation. Keep a stop below levels of 112. Look for target of 118, 119. And the other one which I like is Nika. Gave a good breakout yesterday. Today is quiet, but the structure is positive. So buy here with a stop at about 181 for targets of 195.
Okay, all right. Thank you very much, Mitesh, for that. So those are some individual trades coming up. Commodities and gold very specifically in focus. Manisha joins us on the other side.
So 30 points up on the Nifty now, with banks leading the charge. The bank Nifty is soaring almost 1% higher. That's the shape of the equity market. Let's figure out what's happening with commodities. We have Manisha Gupta joining in with the latest. Manisha, what's capturing your imagination today?
Gold. I'm never not moving away from that. It is bulls in control when it comes to gold prices. And what a stupendous run-up that we've seen. Every single or every second day, you are looking at an all-time high coming into the markets there. So we're trading above $3,280 an ounce at this point in time, which is an all-time high. And with those kind of gains, we are up by 25% in this year after 28% of gains in all of last year. So it has been a one big strong rally that we are seeing in case of the gold prices right now. Well, also when you look at the overall markets, and this is an interesting chart that should come on your screens now. It tells you on how the gold prices have been moving on the higher side. I've taken the last 4 or 5 years here, and we're trading above 3,280 right now. If you look at the month of April last year, same time, it was at 2,350. So almost $1,000 of a jump up per ounce is what you're looking at in case of gold prices in last 12 months itself. April 2023, we were at 2,000, 19, 20. So as you can see, 22 and 23, the gains weren't so much, or at an understandable range therein. But in last 4 years, we've come all the way from 1725 to 3275 right now. So very, very strong gains continuing in case of gold prices, with more and more banks and brokerages now upping their forecast for this year, for 2026. 27 and 28 as well. So banks believe that you could be looking at higher gold prices for the next 3 to 4 years as well. Various factors and which have been supporting the gold prices. One, of course, there's a lot of uncertainty around the U.S. trade policy. And then it is a weak U.S. dollar index, which is trading below 100. So no safe haven buying really coming in for the dollar index. Much of that money really seems to be flowing in case of gold. The falling U.S. Treasury yields has been yet another factor there. And then the markets are looking at very strong inflows that we have in sense of investment in gold ETFs in India, in Asian markets, and most of the global markets therein as well. Also, you're looking at higher U.S. debt numbers. The world debt numbers also have been growing. That has been supportive. And then the markets also are looking at the historical chart pattern data. If you look at the numbers from 2000 to 2025, it has been only 2 years that gold has given you a negative double-digit return. Apart from that, it has been positive cues continuing from gold, and that historical pattern also shows you that gold perhaps continues to be a favorite place to be in. For the Indian markets then, we are trading at above all-time highs, above 94,400. Interestingly, there are no buyers in the Indian markets. Most people tell us that the demand could have declined by 40% in the Q1 part there. And when you look at the markets right now as well, it is more about exchange and old gold coming into the market rather than sales of gold. And that has led to a big discount in the Indian markets. Well, I've been talking to some of the jewelers there, and they say $25 to $28 an ounce of a discount is what you are looking on bill. And in the cash markets, it's as high as $180 to $200 an ounce as well. Clearly, no buyers there. And a final plate should show you on what the banks and brokerages are expecting the gold prices to go from here. These are the only revised banks that I've taken in right now. So Deutsche Bank now says that they see a support at 3139, 3129 kind of levels, and their next target on the higher side is 3700. Goldman Sachs has talked about 3700 as well, with 4000 by the end of this year or middle of 2026. Bank of America and Citi have talked about levels between 3300 to 3500 as well. UBS has revised its forecast. This was a report yesterday at 3,500. De Beer has been saying 33 to 4,500 since the month of December now. And Swiss Asia Capital has talked about 3,500, 3,700 in this year. And the next 3 or 4 years, bullishness may just about continue. What the street, though, will focus in the day today is going to be the U.S. Powell speech and the U.S. retail sales data. That would make an impact on the dollar index and gold prices for the very, very near term, though.
All right, gold it is. Manisha, thank you very much for that. And we'll, of course, put the spotlight very much on this. So many angles to cover as far as gold and how well gold as a commodity has done. Well, we'll take a quick commercial break here. It's the economy on the other side. My colleague Lata speaks with Samir Goyal of Deutsche Bank to discuss global rates, rupee and dollar. Stay tuned. Interesting conversation up next.